Every quarter, we get an update to super investors' portfolios, the stocks they've bought, the stocks they've sold, and today we are looking at the top 10 stocks that these investors have been buying. We're going to run through each one, starting at the 10th most bought stock, which is Adobe, working our way down to the number 1 most bought stock by these individual super investors. And as always, we're going to take a look at each one of these and run it through our valuation to give you what we believe to be our intrinsic value, what Wall Street sees in terms of upside, and our own general thoughts on each one. Now, if you do stick towards the end, we're going to do a little bit of a deeper dive on 3 high-profile investors to see exactly what they have bought and what they have sold. So as we mentioned, number 10 sitting there is Adobe. Now this is one which has a triple buy rating, Seeking Alpha, Wall Street and Quant. It now trades in the midpoint of the 52-week range, doesn't pay a dividend and has a forward P sitting just below 30. Over the last 12 months, it is up around 3%. Over the last 10 years, this has significantly outperformed the S&P, up 649%. As we mentioned, we're going to run each one of these through our valuation model. And as we can see in today's episode for Adobe, we have a price of $581. Now, before we look at any other numbers, we're going to explain how in today's episode we got this value. Where we run it through the DCF model, we have the free cash flow year on year, and we can see the average growth over the last 10 years has just been above 23%. Now, as always, we have 3 different growth rates, a low, medium, and high, 10, 12, and 14%. We've gone for 12%, which is lower than the average of the last 10 years, and in line with what management do target. We get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see here, 581, indicating around 8% upside. Now, just for transparency, if you believe it should be lower at that 10%, what we do note here is that it should be around $505, downside of 6%, and around that 14% level if you believe we should be more optimistic, 668 indicating 24% upside. As always, you can grab a copy of this model by clicking on the pinned comment below to run your own numbers, whether it's for Adobe or any other company. So we're taking in that medium rate of 12% to get an intrinsic value of $581. And as always on this channel, we do a margin of safety starting off at 10%, which we execute if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, in today's episode, Adobe doesn't hit that 10% mark. At the 5% level, it is a buy up to $552. But our thoughts are that you should be looking for a bare minimum of 10%. In fact, ideally, we would like to go higher. 15% around 494, 20% around 464, and around 25% where we would say you should start to consider at $436. As we said though, just a 5% margin of safety in today's episode, but Wall Street, as we saw with the triple buy rating, indicating a price target of $612 and 13% upside. Now, before we move on to the next stock, just to let you know, we have released our latest free weekly article. If you want access to this or any others, you can grab a copy by clicking on the pinned comment below and start reading straight away. We have also released our 35 undervalued stocks for the month of August, and we also talk about in that article the ones that we also own ourselves, so do check that out by clicking below. Moving on, the 9th most bought stock, we have Humana Inc. with a buy from Wall Street, a hold from both Seeking Alpha and Quant. This one trades in the lower end of the 52-week range, with a yield pretty much touching the 1% point. A forward P of 22, not too far off the S&P's 22.5. Over the last year, down 28%. Over the last 10 years though, similar to the previous company Adobe, you would have outperformed the S&P, up 186%. Now, when we talk about Humana and the valuation, well, our intrinsic value of $400 isn't dissimilar from Wall Street's 395, where they do indicate around 10% upside. Now, we won't go through each one looking at the valuation, but for this company, it is the average of these 3 models, and at the $400 mark, when we do imply a 10% MOS, it is pretty much a buy at that level if you do believe that is sufficient. Now, for us, similar to Adobe, we would be looking for a much larger MOS. At 15%, a buy at 340, at 20% around 320, and at the 25% mark at $300, that could be one where you do start to get interested. But as always, it will depend on if you do believe these companies are high quality and fit into your investment portfolio. We also want to mention the majority of these we have done an in-depth deep dive, so if you want to understand more and the underlying metrics, do go check that out on the channel. The 8th most bought stock we have here is Solventum. Now, if you remember, this was a spin-off of 3M, and we do note a double hold here from Seeking Alpha and Wall Street. It does pretty much trade at the lower end of the 52-week range, and a forward P right now sitting just above 9. Now, since the spin-off, it is down around 16%, and given it is a fairly new company, this isn't one we have a valuation on. However, if we do take a look at TipRanks, where they have the upside around 4.71%, they have a price target of just under $61. Now, this isn't one that we would consider around this level, and in fact, given it is a fairly new company, but this isn't one we would look to buy until we have some consistent data. Nonetheless, we can see a very small upside. Coming in at number 7, we have CVS Health Corporation with a buy from Wall Street and a double hold. It is trading right there at its 52-week low with a nice yield, 4.77%, a fairly low forward P of 8.43, and over the last 12 months, it is down around 25%. Over the last 10 years, also down around 30%, as we can see all-time highs around January 2022 at $110, and we can see right now pretty much trading at half that value. In terms of the actual valuation, well, our intrinsic value at $73, not far off Wall Street 72, where they see upside of 28%, and as we just saw, they do believe this is a buy. Now, with our margin of safety at 10%, a buy up to $66, indicating nice MOS in today's episode, 15% 62, at 20% around 59, and we can see not far off a 25% margin of safety. That is based on the estimates and judgments. If you want to see more about these models, do check out the deep dives where we actually run through each one and the inputs. So 25% margin of safety or thereabouts, 28% upside could indicate a strong buy depending on your investment thesis and whether or not you believe in the longevity of CVS Health, which has been struggling over the last few years. As always, let us know your thoughts in the comments below as we do go along. Moving on to number 6, we have MSCI, a high quality company with strong financial metrics, a double buy with a hold from Quant. This one is trading in the mid to upper end of the 52-week range, a yield of 1.17%, and a fairly lofty PE forward basis of 37.4. Over the last year, just up around 1%. However, over the last 10 years, massive outperformance of the S&P, up 1,067%. Now, in terms of MSCI's valuation, our intrinsic value, $602. Wall Street's price target of $600, showing only around 8% upside, so not one that we do believe is a buy right now. As we are about to show, you only have around a 10% MOS, and that is when the price is around $542. At 15%, will it buy at 512? At 20% around 481. You could argue, given it is a high quality company, that 15 to 20% may sit with your investment thesis, and those at 25% would need to wait around $452. As always though, as we go along, and if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. At the halfway point, we have Apple, which is a buy from Wall Street, however a double hold. This one trades at the upper end of the 52-week range, a 0.45% yield, a 33 forward PE, and up around 24% over the last 12 months. Over the last 10 years, again, another significant outperformer of the S&P, up 775%. Now, our intrinsic value at $207, what this ultimately means, first thing is that given the current price is higher, we do believe that Apple is now trading at a premium. We don't believe it anywhere near its fair value, but very interesting. Unlike the majority of the other companies we've looked at, Wall Street are in disagreement with us. They see the forecasted price over the next year at $248 with upside of 12%. Now, if this is one that you are looking for the future and want a 10% MOS, we would say that is around a $186 price. At 15% around 175, and at 20% around 165, and these numbers we have seen not too long ago. In fact, Apple did recently pop, so always bear these external factors too. Number 4, we have Uber Technologies with a strong buy that we see for the first time from Wall Street, a buy from Seek Alpha and a hold from Quant, trading at the upper end of the 52-week range, a forward P just above 69, no dividend for this company as of yet, and up 60% over the last year. Over the last 5 years, up 112%. Another one, like the majority of those today, that has outperformed the S&P. Now, in terms of the intrinsic value, well, at $85, that is above the current price, so we will see a margin of safety today. At 10%, a buy at $77. At 15%, pretty much at that current trading price. And Wall Street, as we said, strong buy for them, upside of 22%, and they have a price target of $88. Coming in at number 3, we have Microsoft Corporation, another strong buy from Wall Street, a buy from Seeking Alpha with a hold from Quant. This one also trades in the upper end of the 52-week range with a yield of 0.72% and a forward P of 31.6. Now up 29% over the last 12 months and another significant outperformer of the S&P, up 822%. Looking at the intrinsic value, $430 with the current price at $418, indicating we don't see a lot of margin in terms of the safety. At the 5% though, we can see $408, so effectively very minimal, 0 to 5%. For those that want it at 10%, well, a buy at $387, which you could argue for one of the most high quality companies in the market today. At 15%, around $365, and for those that do believe we will see these levels at $344, you are getting a 20% MOS. But as we said, 0 to 5 in today's episode, with Wall Street in complete disagreement. As we just saw, a strong buy, they have upside of 20%, and therefore we see no margin of safety and 20% upside over the next year. As always, do let us know your thoughts below. We then move on to stock number 3, United Health Group, with a 3 in a row strong buy from Wall Street, a buy from Seeking Alpha, a hold from Quant, trading right there towards its 52-week high with a yield of 1.46% and a forward P of 21. This is up around 13% over the last year. Over the last 10 years, very strong performance, up nearly 600%. Again, like the majority that we do talk about today, significant outperformance. Now, our intrinsic value of $586 with the current price at the level it is does indicate that this one isn't trading too far off its fair value. So we would say if you are looking for a margin of safety, then this company right now isn't the one for you. At a 10% MOS, well, a buy at 527, at a 15% around 498, and at the 20% mark around 469, which interestingly we have seen these not too long ago. So UNH, no MOS, and as we can see, one that Wall Street agrees with a price forecast of $600, indicating only 4% upside over the next year. So the most bought stock by the super investors is Berkshire Hathaway, with a strong buy from Quant, a double buy from the other two, and trading right there near its 52-week high. Now, for those that don't know, this one doesn't pay a dividend, and we can see the forward P sitting just below 21. Over the last year, well, up 22%. Over the last 10 years, up around 215. One that has also, without that dividend as well, outperformed the S&P, which does pay a dividend. Now, in terms of the valuation of this company, our intrinsic value of $456 is pretty much bang in line with Wall Street of $458, and they only see around 4% upside. No surprises when we do look at the margin of safety. At that 5% level, you would have to wait for around 433. So no margin of safety, trading near what we believe to be its intrinsic value, and Wall Street also indicating low single-digit upside. Now, for those that want a 10% MOS, well, a buy at 410, at 15 around 388, and at 20% around 365. But what we see very common with this company is a lot of people do tend to dollar cost average in to Berkshire Hathaway, similar to what investors do, for example, to the S&P and other notable ETF. As we said at the beginning of the episode, we're going to look at 3 super investors, just a quick overview of their portfolio to see their exact movements, and we're starting off with Warren Buffett's Berkshire Hathaway. Now, a few things to note, no surprises as we have covered this before. He did reduce his Apple stake by nearly 50%. That is pretty much the largest movement, as we can see, a 29% movement to his total portfolio. The other ones are very, very minimal, but some things that we just want to highlight. He has started 2 new positions. Ulta Beauty, one that we've talked about being significantly undervalued. He did buy, although a fairly small position at 690,000 shares. It is 0.1% of his portfolio, and in fact, it could be one that he does increase over the next few quarters. He's also continued to add to his portfolio of Occidental Chubb Limited, which was a new buy in the previous quarter, as well as Liberty and Sirius XM Holding. He has now also fully sold out of his Snowflake position, as well as Paramount Global. The next one we're looking at is the Bill and Melinda Gates Foundation Trust. Not too many movements in the portfolio. The major one here that we can see being adding 42% to their current position of Berkshire Hathaway. As we said, that was the number 1 stock that was bought by these super investors in quarter 2. We do also note he has reduced his Microsoft position, although fairly small at 4.4%, and also fully sold out of Carvana, 520,000 shares, again not the largest in terms of his portfolio. Finally, we're taking a look at Bill Ackman, and we can see some interesting things here to note. He's reduced his position in Chipotle Mexican Grill as well as Alphabet, some of the biggest sales in his portfolio, and interestingly he has added Nike. Now this is one, as we've talked about for a long time, that does look to be undervalued, although it is a fairly small position, around 2.2% of his total portfolio. He has also added Brookfield, as we can see, slightly larger, around 2.73. Now don't forget to sign up to our free weekly newsletter, as on Monday we will be releasing an in-depth look at all of these super investors and their movements in their portfolio. And if you do want to come and talk to us about our weekly buys and sells, do come and join up to the Patreon below. As always, if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, and don't forget to let us know your thoughts below. As always, have a great day, and we'll see you all on the next one.